Welcome to this webinar dedicated to our latest benchmark of 2021 year-end financial statement of a panel of European banks. My name is Vincent Guillard and I am a partner at Mazars in charge of IFRS for financial instrument related issues. I will perform this presentation today with Nicolas Millot, who has coordinated this benchmark study. This presentation will last about 45 minutes and will focus on the main findings of the benchmark. We will therefore not present the whole set of slides. You will see that we will skip part of them. You will receive soon a mail with a link that will allow you to download both the record of this presentation and the comprehensive study in PDF format. You may ask questions during the presentation in the chat, and we will do our best to answer most of them at the end of this presentation. With that, I will have a few words to present the methodology. The sample we used is the same as our previous studies in H1 2021 on year-end 2020. So it is about 26 European banks. You see them on the graph from 11 countries. The most represented countries are 4 entities for France, 4 entities for Spain, and 5 UK banks. We used only information from annual reports, that is to say, audited information published before the 1st of April 2022. When a bank is not represented on a given graph, it means that the required information was not available. Our main purpose is to highlight trends across the sample or by geographical areas and not to explain the changes of a specific given bank. At least we will not do so during this presentation. Lastly, just a word on the key element of vocabulary. We will talk about ECL charge, meaning an ECL expense in the P&L of the year. So ECL charge means a P&L approach, as opposed to ECL allowance, which is an amount on the balance sheets, the amount of impairment allowance on the statement of financial position. So it's important not to be confused between the two. ECL charge or expense means profit or loss, and ECL allowance means balance sheet view. With that, I'll leave the floor to Nicolas, who will start with the first draft of the presentation.
Thank you, Vincent. So in this first graph, we wanted to show the weight in percentage of ECL charge in operating profit or loss before ECL charge. So these ratios are computed by dividing the ECL charge by the operating profit or loss before ECL charge. We compare here both years, 2021 and 2020. In 2020, which are the gray bars in the graph, you see that some ratios are over 100%, meaning that the banks realized an operating loss, at year-end 2020, as ECL charge exceeds the operating profit before ECL. For 2021, a blue bar means a net ECL charge, and a purple bar means a net ECL release, and as you can see, for example, for most UK and Irish banks. So what are the main conclusions of this graph? Well, first, we can see that at year-end 2021, the share of ECL in operating profit and loss ranges from minus 64% to plus 64%. The ECL charge amounts to 20% in average of operating profit or loss before ECL charge at year-end 2021 versus 78% at 2020. We will develop further the analysis of the ECL amounts, but this trend may firstly be partly explained by an improvement of the operating profit or loss before ECL, meaning the denominator of the ratio that increased by 21% in average compared to 2020. With that first element, I leave now the floor to Vincent to present you more details about the changes in ECL charge.
Thank you, Nicolas. So let's have a look to this second graph. This graph is a focus on the level of cost of risk of banks over the period. The bars represent the change in ECL charge or release, so the P&L, between 2020 and 2021. The blue bars means that the net ECL charge decreased between 2020 and 2021, but still represent a positive cost of risk, that is to say, an expense. The pink bar means that the net ECL charge decreased between 2020 and 2021 in such proportion beyond 100%, so that the cost of risk has become negative in 2021, resulting in a profit. The points, the dot that you see, represent the change in the cost of risk, comparing the situation before the COVID period, that is to say in 2019, and the average cost of risk calculated over 2020 and 2021. If the point is close to zero, it means that on average over the period, the cost of risk has been similar to the level of the cost of risk in 2019. So what can we say on this graph? First, we see that all banks have experienced a reduction in the cost of risk expense in 2021 compared to 2020. All the bars are negative. 9 of them even experience a negative cost of risk over the year. But this reduction in cost of risk in 2021 has not been sufficient to offset the increase we observed in 2020. The average cost of risk over the 2 years of the period COVID-19 increased by 70% compared to its 2019 level. You see that all the dots, except one, are positive. Only 6 banks in the sample had an average increase of cost of risk below 30% compared to 2019. And only 1 bank in the sample experienced an average decrease of its average COVID-19 period cost of risk compared to 2019. That's the bank Sweden 2. We can note that almost all UK banks experience a negative cost of risk in 2021. On a cumulative basis over the last 2 years, the position of the UK banks are heterogeneous, with 2 of them having a 2-year average cost of risk close to their 2019 level. You see them there. Whereas 3 others have more than 30%, are more than 30% above 2019 levels, but still well below the average of the sample, which is at 70%. With that, I move to the next slide and leave the floor to Nicolas on this graph.
Thank you, Vincent. So now we're talking about the ECL coverage ratios of amortized cost loans. So the purpose of this ratio is to show the ratio between the ECL allowance in the balance sheet amount divided by the level of gross exposures. It could be seen as an indicator of quality of the portfolio, but also as an indicator of the management judgment on the credit risk portfolio. So regarding the data, we have here the same indicator at two different dates for 2021 with the blue bars and 2020 with the gray bars. Here we present the ratio calculated based on all amortized cost loans. So we are excluding fair value through OCI instruments, securities, and off-balance sheet exposures. And we encompass both financial institutions, public and retail customers. It should be noted also that even calculated on amortized cost loans only, this indicator has a quite aggregated level and therefore should be seen as an indicator of the trend. And the last element you can see is the pink area representing the change in the coverage ratios between 2020 and 2021. So what can we say now about this graph? First thing is that the average ECL coverage ratio of amortized cost loans is 1.5% at year-end 2021 compared to 1.8% at 2020. We see that almost all banks show a decrease in their coverage ratios, even for banks that have an ECL charge, meaning a positive cost of risk, in 2021. We can note that the decrease results from a seesaw effect between the gross carrying exposures that increased by 5% in average between 2020 and 2021, and the ECL allowances that decreased by 13% in average between 2020 and 2021. This detail is presented in the previous slide, so if you want to see more about it, you will have the opportunity when this study will be made available. We can also note that compared to last year, we still observe diversity in the levels of global ECL coverage ratios, but the range narrowed compared to 2020. It is between 0.2% and 3.2% on 2021, compared to 0.3% to 4.2% on 2020. However, as for 2020, we still observe a fairly strong consistency in each country. French banks, for example, are close to the average, whereas Spanish, Italian, and Irish banks are above, and Dutch, Swedish, and German banks are below. Moving to the next slide, we can see that a detailed analysis by stages evidenced that stage 1 and stage 2 coverage ratios have decreased in most countries, whereas changes in stage 3 coverage ratios are more heterogeneous from one country to another. So we have finished with a year-to-date review of the coverage ratios. Now I leave the floor to Vincent to comment more about the pre-crisis coverage ratios.
So on this graph, what we show you is exactly the same graph as before, but for the period comparing 2021 situation with 2019 figures, that is to say, the situation before the crisis and after the crisis. What can we say? The average ECL coverage ratio of amortized cost loans is 1.5% at year-end 2021 versus 1.6% at year-end 2019. So on an average in Europe, the amortized cost loan coverage ratio is slightly lower compared to 2019, which may raise questions given the current uncertainties. Two factors may have contributed to such a trend. The first one is the increase of support measures and especially guarantee mechanism provided by some governments that may have decreased the loss given default or deferred the probability of default and therefore the move from one stage to another. The second one is, with a particular reference to Italy, the deleveraging policies reflected in significant disposal of non-performing loans that resulted in a decrease of the related coverage ratio. If we look at the situation by country, we can identify quite consistent trends. French banks are a little bit below their 2019 levels, whereas German and Spanish are a little bit higher than in 2019. Most significant increase of coverage ratio occurred in Ireland banks that now stand well above the average of our panel. Now let's have a look at the graph by stage. It is always interesting to remind the relative value of the average coverage ratio by stage. So what we see here is that in 2021, the average stage 1 coverage ratio was 20 BP. For stage 2, it was 3.8%, so nearly 20 times more. And for stage 3, it was 40%, so roughly 10 times more than stage 2. So please keep this number in mind. It will help explain some graph later on in this presentation. So you have stage 2 about 20 times more than stage 1, and stage 3 10 times more than stage 2. It's hard to isolate general trends without an in-depth analysis of each graph, and we are lacking time today, but we can note that between 2019 and 2021, the coverage ratio increased on average for stage 1 and stage 2, respectively by 3 and 35 BP, but it decreased on the stage 3 by 50 BP, probably or maybe as a result of the NPL management initiatives as mentioned earlier. With that, I leave the floor to Nicolas, who will give additional information of allocation by stage.
Thank you, Vincent. So in this first slide, what you can see is that we first allocated the gross carrying exposures by impairment stages for 2021 and 2020. As you can see, the proportion of stage 1 in the total GCE and ECL allowances is depicted in green, the proportion of stage 2 in gray, and the proportion of stage 3 in purple. Moving to the next slide, we did exactly the same thing as for the previous slide, but this time for ECL allowances and not only for gross carrying exposures. So after this first static analysis, we draw in the next slide the variations in allocation between stages, first between 2020 and 2021, then between 2019 and 2021. For today's webinar, we decided to directly compare the 2021 situation to the pre-COVID situation in 2019. So that's the slide you are seeing now. So the changes are expressed here in BPs, and this change is always relative and balanced, meaning that an increase of stage 1 proportion has to be in counterpart from a decrease of the proportion of stage 2 or stage 3. In the graph presented here, we can compare the change in gross carrying exposures on the left of the slide to the change in ECL allowance on the right of the slide. A bar to the left in a graph represents a decrease in proportion, and a bar to the right represents an increase of the proportion. The sum of the two being always 0, which can be seen through the symmetrical shape of the graph. So what are the key takeaways of this graph? So first, we can see that even if the extent of variations of gross carrying exposure proportion is diverse, we can see a pretty consistent trend across all banks, consisting in an increase of the proportion of stage 2, to the detriment of stage 1 and to a lesser extent to stage 3. Surprisingly enough, even the slight decrease in the proportion of stage 3 gross carrying amounts led to an amplified decrease in the proportion of stage 3 when considering ECL allowances. This is explained by the differences in coverage ratios between stages and the scale effects that Vincent presented you, because on average in 2021, as you saw, you have a 400 multiplication factor between stage 1 coverage ratio and stage 3 coverage ratios. So now we have finished with the allocation by stages. Now I leave the floor to Vincent to present you another topic dedicated to cumulative overlays.
Thank you, Nicolas. So now let's have a look to this slide. This graph on the right side shows the weight of cumulative overlays in the amortized cost loans ECL allowances in year-end 2021 for the blue bar, on year-end 2020 for the gray bar. So it represents a balance sheet point of view, the weight of overlay on the amount of impairment allowance on the balance sheet. We define a post-model adjustment as any adjustment presented by the banks as being outside of the IFRS 9 impairment model. So we rely on the disclosure of the bank. In case of multiple overlays, represent here the sum of these adjustments. Please note that if the majority of these adjustments are linked to the COVID crisis, other reasons are mentioned by banks, such as for specific NPL portfolio or issues related to model calibrations. What can we have as takeaway? The first one is the weight of overlays in ECL allowances on the balance sheet increased in 2021 to reach 17% versus 14% in 2020. If we now look at overlays impact in the cost of risk of the period, so the P&L point of view, in average, change in overlays represented nearly half, 48% of the ECL profit or loss before overlays in absolute value. That is for 2021, nearly half. Last year in 2020, it was 27%. So there is a persistent increase in the weight of overlay, both from a balance sheet point of view and from a weight or proportion of cost of risk in the P&L view. The appearance and persistence of this significant proportion of overlay is one of the major takeaways of the COVID-19 crisis. We will follow up how the use of overlays will behave in 2022, taking into account the new uncertainties stemming from war in Ukraine. Now, let's move. You will find additional information on overlays in the presentation, but I suggest that we move directly to the forward-looking information that will be presented by Nicolas.
Thank you, Vincent. So in this part, we are focusing on forward-looking information, and in particular on the macroeconomic scenarios and inputs that are used by banks for calculating their ECL. So in this first graph, you can see the number of scenarios that are disclosed by each bank. You will know that only 3 banks did not disclose the number of scenarios they use for their forward-looking information. We can also know that very few banks change the number of scenarios, and maybe as a last conclusion, an outlier, which is UK4, which has disclosed having more than 5 scenarios. Indeed, they present 50 scenarios weighted at 2% each. Now, if we move to the next slide, we are focusing in more details about the weightings of macroeconomic scenarios and their variations compared to last year. So in the first graph here, you can see the weightings of the scenarios for each bank in 2021. So in this graph, 21 banks have disclosed their weightings. In purple, you have the downside or pessimistic scenarios. In gray, the central or baseline scenarios, and in green, the upside or optimistic scenarios. We have classified the scenarios in 3 categories only: a baseline or central scenario, an optimistic or upside scenario, and a pessimistic or downside scenario. When the number of scenarios was above 3, comprised of 2 downside scenarios, for instance, the weightings of the 2 downside scenarios were added, and we presented only 1 global downside scenario. The second graph depicts the changes in the weightings of the scenarios between 2020 and 2021. When a line shows no bar, it means the weighting has not changed since 2020. It doesn't mean that the information is not disclosed. So the 6 banks that do not disclose this information for both 2020 and 2021 have no dedicated line in this graph. So what can we say about these graphs? So the major conclusion is that this is an illustration of the diversity of approaches applied by the banks. On the one hand, concerning the weightings of the optimistic and pessimistic scenarios, even within each country. And on the other hand, concerning the change of those weightings between 2020 and 2021. You see that 11 banks have changed their weightings, meaning that 15 banks did not. And among the 11 banks, 4 of them weighted more the downside scenario, whereas the other banks lightened it. So quite contrasted results for this graph. Forward-looking impacts are due to both weightings of the scenarios, but also the underlying parameters. So we note also that the change in the weighting is not in itself sufficient to draw conclusions about a direct impact on ECL. The increase of a downside scenario may be offset by a positive update of the underlying parameters of the scenarios, for example. To that regards, we know that French banks differentiate by an overall increase of the weighting of their downside scenario in 2021, but this indicator can only be correctly analyzed with regards to the changes in the assumptions of the scenarios. The FR3 explicitly disclosed, for example, that scenarios weightings are based on their proximity to the consensus forecast, whereas the 2 other French banks disclose that their weightings depend on the position in the credit cycle, meaning that the adverse scenario carries a higher weight at the upper end of the cycle in anticipation of a potential downturn in the economy. We will see in the next slide how these underlying macroeconomic parameters have been assessed by banks and if a homogeneous trend of assumptions can be seen.
We will not present here all the analysis we performed, and we decided to select for this webinar the comparison on Eurozone GDP growth, for which 7 banks provided their assumptions. The graph presents the cumulative projected GDP growth rate with an index base of 100 in 2020. The chart shows the annual GDP growth rate for each year, that is to say, not on a cumulative basis, but it's the yearly growth rate. Within the chart, the pink cells emphasizes an assumption that is more optimistic than the ECB scenario. You see the ECB scenario in the first line of the chart. And a gray zone emphasizes an assumption more conservative than the ECB scenario. Empty cells in the chart mean that figures were not disclosed for this year by the bank concerned. So what can be the comments there? The sample is overall more conservative than the ECB in terms of GDP growth assumptions over the long run. But there are some diversity as illustrated by German banks. The German banks from our sample disclose heterogeneous macroeconomic inputs despite sharing similar geographical exposure. Deutsche one, the German one, present the less favorable scenario GDP assumptions of our sample, whereas Deutsche 2, German 2 has, on average, the most optimistic ones over the time horizon disclosed. Now, I will skip a couple of slides on other macroeconomic indicators to move to some key other topics. On what this one is one of the regulator favorite, I would say. So let's have a look on NPL. We disclose two graphs in relation to non-performing loans. The first one depicts the NPL ratio, that is to say the percentage of loans that are considered to be non-performing among the loan population selected by the bank. The second one on the right of the presentation presents the NPL coverage ratio, that is to say the share of a non-performing loan gross exposure that is covered by an ECL allowance. For both graphs, the blue bar represents the ratio communicated for year-end 2021 and the gray bar the ratio for year-end 2020. We chose to disclose only the ratios that were explicitly communicated by the banks in their annual report. We did not make any interpretation nor computation of NPL coverage ratio by ourselves. So what can we get out of this graph? First, 17 banks disclose an NPL ratio and 16 banks disclose an NPL coverage ratio. We can note that European banks have used heterogeneous definition of the denominator used for this ratio. Some banks included in the denominator of the NPL ratio the off-balance sheet exposures or securities at amortized cost, whereas other banks excluded them. 8 banks that disclose a NPL ratio gave no clear definition of this ratio. For these reasons, it is difficult to compare one bank with another. We nevertheless observe the following trends. First, almost all banks experience a decrease in their NPL ratio between 2020 and 2021. And almost all banks experience a decrease in their NPL coverage ratio as well over the same period. I will now leave the floor to Nicolas, who will investigate further on the significant increase in credit risk criteria analysis.
Thank you, Vincent. So now you can see 4 graphs representing our key findings on the CCAR approach by the banks. The first one presents banks that explicitly disclose at least one qualitative CCAR criterion, for example, forbearance or watch list. The second one presents the share of banks having disclosed quantitative thresholds for at least one portfolio or type of financial assets. For example, when a bank said there is a transfer in stage 2, when the probability of default increases by 100%, or when the internal grade is downgraded by at least 2 notches, etc. In the third graph, we have considered that banks disclose differentiated approaches when they at least disclose 2 portfolios with different CCAR criteria for each portfolio. It does not mean that banks that are classified as no in this graph has no different approaches suited to their different portfolios. It just means that they did not disclose information to confirm these differentiated approaches. In the last graph, we have identified banks that disclose an absolute CCAR threshold when one or more threshold that do not take into account the initial PD of a given financial instrument were disclosed. For example, when a bank said there is a transfer in stage 2 when the PD of an instrument reaches 10% or when the internal grade is above 4, no matter how it started. So what are the main conclusions from our review on the CCAR approach? First, in general, we can see an improvement in the details provided by banks on their methodologies, as most of them first disclose relative thresholds numbers. There are 20 banks that disclose this information. Almost all banks disclose at least one qualitative CCAR criterion, mostly forbearance for 17 banks, and watch lists for 14 banks. However, it should be noted that the diversity observed, taking into account qualitative information, absolute thresholds, and methodologies for their relative thresholds, complexified the comparisons. To illustrate the diversity, we can quote some examples of quantitative information provided by some banks on their relative PD thresholds methodologies. For example, we have seen that all Irish and UK banks have disclosed a stage 2 transfer trigger when PD increases by more than 100%. Regarding other countries, 2 banks have explicitly disclosed to follow the EBA and ECB recommendations. That means transferring in stage 2 loans for which PD has been multiplied by 3 since their initial recognition, whereas 2 other banks have disclosed using an initial PD multiplication factor of respectively 2.5 and 3.75. So we have finished with the CCAR approach. Now I leave the floor to Vincent to talk about another very important topic, which is green finance.
Thank you, Nicolas. This graph presents the eligible asset ratio published by the banks of our panel. Despite seemingly standardized definition of the mandatory taxonomy eligible asset ratio, banks present very different amounts, even in a given country. This may be explained by judgments used in the application of the Article 8 of the EU taxonomy regulation and the different nature of the activities and sectors to which the banks are exposed. We can note as well that half of the sample decided to publish a voluntary eligible asset ratio that, in practice, has been always higher than the mandatory one. Further comparative analysis would have required a more standardized and detailed information on the bank's total assets allocation. We can guess that in this regard, improvement will be seen in the coming years. Now, Nicolas will have a word on the first review of the war in Ukraine.
Thank you, Vincent. We have analyzed the information included either in the annual report 2021, when published after the beginning of the war and updated accordingly, or dedicated press releases that have been issued to deal specifically with this issue before 1st of April 2022. So that was our main sources of information to make this first review in year-end closing perspective. Most banks have published a first macroeconomic analysis, for example, through CEO letters, but less than half of them have disclosed entity-specific information, beside the first macroeconomic generally shared analysis. This is because at this date, direct exposures to Russian and Ukrainian counterparties or interests were very limited, only 2 banks disclosed a total net exposure equal to or higher than 1%. However, this first assessment may have changed by now, as banks now consider not only direct but also indirect exposures to Ukraine and Russia, meaning, for example, assets or exposures that are not directly located in those countries, but may be impacted by the war through the increase in the prices of oil or gas or other commodities, or through the worldwide supply chain problems, for example. The publications of the first semester 2022 will certainly provide a more accurate view on this issue, but waiting for more detailed publications, Mazars has already published an overview of the stakes and the potential impacts of the war in Ukraine on banking and insurance companies. This study is already available on our website if you want to see more about it.
Thank you, Nicolas. That's definitely one of the topics we will follow up closely over the next benchmark, starting with the benchmark on H1 2022. So that's the end of this presentation. You have seen that we have skipped quite a couple of slides, so we try to focus today on the main key information, key takeaways from this benchmark, but you will have access to more detailed information within the file. So just as a reminder, you will receive soon a mail with a link to download both the recording of this presentation and the presentation, the comprehensive presentation as well. Nicolas, could you tell me if we have one question to address in order to match the timing of 45 minutes, maybe one question?
Yes, we have one. It deals about sustainable finance. The question is if we have more information about ESG loans and their accounting impact for 2021.
Oh, yes, I suggest that the question relates to whether ESG loans could be compatible with an SPPI test. So definitely a hot topic. What we can say here is that very few banks disclosed detailed analysis on that. I think it's about 3 banks, something like that. And very little information about the impact of IFRS 9 classification, and none of them, if I remember correctly, mention an impact on classification. So this is currently a topic discussed by the IASB in the context of the IFRS 9 post-implementation review, and definitely a topic to be followed up. Because this sustainable finance issue is related to a market that is growing very fast. So the topics may be even more significant months after months. So yes, definitely something to follow up in the coming months in terms of the IASB position on this topic as they are having a look at it. Well, before closing this webinar, I cannot stop without a warm thank you to the whole team who contributed to this study. You see their name there across the different countries that were involved in this benchmark study. Thanks a lot, Nicolas, for your coordination role in this work. Have a very good end of the day, all of you, and thank you for your attention. Goodbye.
Goodbye.